The dissenter, Loretta Mester, fair enough, her language, compelled to a gradual path. And then I started the day with the break-evens, they're rising. Does this add to the validity of that argument?
It certainly adds to the inflation hawks within the FOMC, which probably of those three dissenters, most of them are looking at the leading indicators, not just from oil, which we've spoken about already on the programme, but also from food prices. Spot food prices up 55 to 60% year on year, the kind of rate of input price inflation across the globe we haven't seen since the back end of 2011. So with inflation expectations well anchored, which is what Loretta Mester was saying, then actually they just want to get ahead of the curve on the expectation that, I think, two things. The economic jobs data, particularly we look forward to Friday, and the non-farm payrolls data, continues to show a strong US labour market, but also those inflation indicators through the commodity routes, both soft commodities and oil, continue to trend upwards.
Can I ask you about the link between politics and interest rates? Because whenever you ask Fed officials, as our colleague Kathleen Hayes did there, really, are you really going to hike just before a big event like the presidential election? They always say we are not political, politics doesn't influence us. But there's a difference between being swayed by one side of the political argument and just pausing because there is a big political event on the horizon. Yeah. And you can, isn't that a valid path of argument, that there's something big going to happen in 6-7 days, therefore don't do anything to destabilise things?
I think you have to look back at the fact that central banks are given such power that is effectively unelected power. It's power bequeathed on them by politicians, and therefore the stock answer running into a presidential election will be around the independence of the institution away from the politics, because that's almost the raison d'etre of the FOMC. And at that point you go, okay, the politics will overtake it, but you won't get a single public utterance from FOMC members that will sway their opinion, because that would undermine the whole case for an independent central bank.
The warning from Dudley on the other side is about that he's listening to other economists talking about the risk of recession, and in that event, what would you do? I mean, it's interesting that you've got this dichotomy between Mester talking about 2% and just above average long-term growth, and Dudley, I'm listening to people warning about recession.
Yeah, I mean, the recession likelihoods have increased on most metrics, but from a very low base, and they're certainly not flashing amber, certainly not flashing red. What is William Dudley looking at? He's probably looking at where I think I am, which is the asymmetry of risks here, which is that we simply don't know with conflicting data. Yesterday was a little microcosm in the US economy with conflicting data out of different manufacturing PMI studies, then also some mixed messages out of car production. In that environment, given that the risk of tightening too soon, given you have very little ammunition to the downside, more than outweighs the risk of going too early. I think that asymmetry of risk will win the day at both the November meeting and the December meeting.
So you weren't swayed about the strength of manufacturing, because that seems to be something that's pushing the dollar higher?
I didn't see compelling evidence that we're going to see a demand-led push of inflation above 2% in the medium run.